Hi everybody, and welcome back to the channel. So in this video I thought we could actually do a complete deep dive into beginner investing, and specifically regarding dividends. Okay, so when it comes to dividend investing, keep in mind that anytime you receive a dividend from a company, you are receiving part of their earnings, essentially. So part of their cash flow and what they have available to pay out to shareholders. And a perfect example of this is Coca-Cola. Now, this is a company that if you go back over the last 40 years, you'll see on the chart it only goes back to 1984. Now, Coca-Cola has been around for a lot longer than this, but basically, since the early 20th century, this company has grown to such a massive size. And in the process of that, I think for over 60 years now, Coke has paid out, and also they've been raising their dividends every single year. And so what you have to understand about buying a company like Coke is that whenever you receive dividends, you are receiving part of their earnings that they're making. So you're a part owner in the company, essentially. And if you go buy one share of Coca-Cola right now for $63.85 by opening a brokerage account, which is if you're brand new to the stock market, come on over to Daily Investment Advice. We have a lot of free education that can help you as an investor. Come on over to Beginner Investing, choosing a broker or financial advisor. It'll give you step-by-step guidance on considerations to think about when you're choosing a broker if you're a beginner to the markets. And then also, once you're ready, come on over to Cash Flow and Dividends. We have a lot of articles, including this one, this video I just made on how to make over $1,000 per month in monthly dividends long-term, setting that up for your family or whatever purpose you're investing for. And when it comes to the dividend investing in particular, keep in mind that there's two ways you can make money in the stock market. So when you invest in a stock, when you're buying partial ownership in a company, what you have to understand is that some of these companies don't pay dividends. So if we take a company like, trying to think of an example, but basically any kind of growth stock. Now, NVIDIA, I think, actually pays a small dividend as well. That would be an example of a hyper growth stock. And a company that I don't think has paid dividends until recent, maybe they've been paying dividends. I honestly don't know, but they would be considered like a growth stock. And if you look at, let's just look up the chart of NVIDIA to show you an example. All the gains from NVIDIA pretty much are coming from this share price going parabolic. So somebody who buys the stock at $15 a share and wants to hopefully sell it to somebody else at a higher price. So that's called the greater fool theory. Now, there's nothing wrong with that, essentially. I mean, you have a real business here with NVIDIA, right? So they're growing AI chips and all that kind of stuff. So it's a real growth story. But the question is, what is the valuation that you're seeking on a company like this? I mean, what is the valuation that one would feel comfortable investing at? And so somebody who's buying down here in 2020, under $10 per share, split adjusted, since they just did what's called a forward split. That's another story altogether. But basically, if you look at this company, somebody who bought at $10 per share and wants to sell now is selling to somebody for over 10x the price they paid for it originally. So somebody who's done nothing but buy this stock and hold it for 4 years is realizing quite a substantial return. The risk associated with that is, of course, the idea or the potential that the stock never makes a recovery. So somebody who's buying at $120 a share has to understand that they're paying a very high valuation, arguably, for NVIDIA. And when it comes to dividend investing, it's just different. It's not all about the share price. It's not about, you pay $5 a share and then you sell it to somebody for $25 a share and you hope to make money that way. But with dividend investing, you're receiving a constant return no matter what. So if you think about, and this is kind of the analogy I like to use, because I understand that stocks and real estate are definitely different, but when you think about a monthly rental property, let's say you go buy a single family home and you want to try to rent it out to make money from the cash flow. Well, it's kind of the same thing with dividends. You're investing something, right? So either way, you're investing in a rental property or you're investing in a company, an individual stock in this case like Coca-Cola, or you're investing into an ETF, let's say, or a mutual fund. So an exchange traded fund, and we have education on that as well. Come on over to Beginner Investing. Come on over to Investing Fundamentals and all that kind of stuff you can learn. Also at the search bar, you just come over here to the top in the search bar, type in exchange traded funds, learn all about these different types of investment products, because there are actual funds that we're going to talk about in this video that pay dividends. And one of those actually is called the Vanguard Dividend Appreciation Index Fund, or ETF. So real quick, this is basically just a collection of companies that, so just like Coca-Cola is a dividend paying company, it's thrown into a basket of other companies, and all of these companies combined make up this ETF. So this is what you call a diversified ETF that has a collection of companies that pay dividends, and then they take those dividends and pay it out to you. But you can buy this ETF, or exchange traded fund, just like you could Coca-Cola stock, by opening a brokerage account or by working with a financial advisor, etc. So there's a lot of things to consider here, but one of the main considerations is always just keep in mind there's two ways to make money in the markets. One is through capital appreciation, which we just kind of talked about with NVIDIA as an example. And then there's also the dividend aspect, which is, share price growth is nice. I mean, if you look back at Coca-Cola, for example, even since, let's say, 10 years ago, so you've gotten some share price growth. I mean, the stock has gone from 38 to 63, so roughly $25 per share. But what you also have to understand about a company like Coca-Cola, and this is important as a dividend investor to understand, is that when you actually look at their dividends over the last 10 years, you'll notice this here, first of all, the yield. We'll go into that, and you'll also notice how much they're paying on a quarterly basis. Keep in mind, most companies will pay dividends on a quarterly basis, and when it comes to the annual dividend yield, that's a representation of, based upon this share price, how much they're paying out in dividends. And so you could take, let's say, $10,000 as an investment, multiply it by the dividend yield of 0.0304, right? 0.0304, 3%. And then that would give you the total amount of dividends you can expect to receive based upon that dividend yield. But there's some flaws in that calculation. We can get into that if we have time in this video. I don't want to make this too long and too overwhelming, because I know, for beginners getting into this, I want to make sure I kind of just run through the simplicity of all this so that you understand the fundamentals. Because once you understand the fundamentals, it's going to be a lot easier to implement this in real life. So what we have here is Coca-Cola. And like I said, most companies pay dividends on a quarterly basis. So what you'll notice here is that these payment days are when the company's actually paying out the dividend to shareholders. You'll also notice some other days here, the declaration day, the record day. So this is basically the day they declare the dividend, the X day, and the record day. These two get confused often. We can get into that as well. Okay, so if we type in, let's just real quick, the X day versus record day. Okay, now, like I said, I don't want to overcomplicate this, but basically the ex-dividend day for stocks is usually set one business day before the record day. If you purchase a stock on an ex-dividend day or after, you will not receive the next dividend payment. Instead, the seller will get the dividend. However, if you purchase before the ex-dividend day, you will get the dividend. So that's a primary consideration. If you purchase one day before the ex-dividend day, you will get the dividend. So before the ex-dividend, you get the dividend. If you purchase a stock on the ex-dividend day or after, you will not receive the next dividend payment. So different than the payment day, because that's when the dividend's actually paid out. But with this ex-dividend day, what we have here is the day that you have to own the stock one day before. Okay, and then if you do that, then you will receive the dividend when it's paid out. So in this case, Coca-Cola, for their most recent quarterly dividend on 6/14/24, paid out on 7/1/24. So we have a dividend of 0.485. That's 48.5 cents. And I know it kind of looks weird, but you can actually go over several decimal places when you're paying out dividends, because when you're paying it out to, in this case, millions of shareholders, essentially, you have to, I'm not sure exactly how many shareholders Coca-Cola would have. I would assume it's in the millions, even if there's a lot of people who only own one share. Nonetheless, when you're paying out these dividends, they can fraction it down, because on such a large scale for such a big company like Coke, it's one of those things where you might want to try to pinpoint those numbers as closely as possible, perhaps to save money even on the dividend. Instead of paying 49 cents, you're going to pay 48.5 cents across the board. That saves you half a penny, which can be used for other things. Because anytime you're paying out dividends, keep in mind, you're actually kind of weakening the company. So I say weakening because Coca-Cola is a very strong company, obviously. We know they've been around for many decades. But cash is leaving the business anytime these dividends are paid. So us shareholders in the company, we love these dividends. And I was kind of using the rental property analogy, and I think that's something to think about, because when you have a rental property that pays on a monthly basis, in this case we're getting paid on a quarterly basis, but nonetheless we're still getting paid something for investing our money into this stock, right? So that's the beauty of dividend investing. And as we were talking about, is that you're not focused on that capital appreciation. You're not taking the risk on the share price. You know, hopefully, that Coca-Cola, and nothing's ever guaranteed in the stock market. There's been companies that have cut their dividends. That's something else to watch out for. But when it comes to actually paying these dividends out, they're taking from their own earnings, their own cash flow. So as long as Coca-Cola remains a strong company and continues to be profitable, you should have no issues receiving these dividends. Now, the board could also come along and say, hey, we want to cut the dividend. And then you could see this dividend go from 48.5 cents down to, let's say, under 40 cents a share, just as an example. But you do see that, and you have to watch out for that, because one big trap, and this is a major consideration if you're a dividend investor, a lot of people want to focus on the yield, right? They want to focus on, hey, this dividend yield of 3.03%, that's not a lot. I mean, I can go put my money in the bank right now, and I can earn, 5% on a high yield savings account. But keep in mind, that high yield savings account is just paying out simple interest, and there's not a lot of, basically with a high yield savings account, they might be paying 5%, but there's no potential for growth. And I kind of got distracted, but we were talking about going over the last 10 years. And one thing you'll notice here with Coca-Cola is that 10 years ago, Coke was paying 30.5 cents, okay, essentially. So they were paying, going into 2014, 30.5 cents. Now they're paying 0.485. So if you think about that, that's almost over 50% dividend growth versus a company that might have a dividend yield of 10%, right? So you might have a company that has a very high dividend yield, but then they actually end up cutting that dividend. So now what happens is, not only will the yield shrink based upon the current price, but also you will have the dividend. So the dividend's going down, the yield shrinking, and most likely if they're doing dividend cuts, that's not a good sign, is what I'm trying to say. So all these are considerations as a dividend investor. And we just went over an individual company. We just went over the X day, which is what you have to own the stock one business day before this day to receive the dividend on the payment day. Okay, I know it gets kind of weird with these different dates, but then you have the cash amount of the dividend. You have the frequency, which in this case is quarterly, because we can see that they pay every 3 months, like clockwork, right? So every 3 months you're going to receive a dividend pretty much. And they've been doing this for several years, so there's consistency, there's reliability in those dividends. Now, to actually calculate this dividend yield here, 3.03%, and then I'll get into another company and some other things as well to consider. What we do is we take the dividend yield divided by, we take the annual dividend. So what we do is we take this annual dividend here and we divide it by the current price, which is $63.89 right now. So we'll take $1.94 dividend divided by Coca-Cola's current trading price, which in this case would be $63.89. And that's the price you can buy it for right now at a broker. And as you'll see, that dividend yield is accurate at 0.0303%. So actually, when you round up, it would be 0.0304 or 3.04%. Nonetheless, you get the idea. So all we're doing when we're calculating the dividend yield is taking the annual dividend, which is a sum of all 4 quarterly dividends. So in this case, if we take 0.485 times 4, then it should add up to that number. So this will give us the total annual amount of Coke's dividends, right? So $1.94, and we have, $1.94. Then to calculate that dividend yield, once again, we take $1.94 divided by the current trading price of, let's say now it's $63.90 if you're going to buy it at the asking price. And we have Coke's total dividend yield at 0.0303 once again. So 3.03% when you just move that decimal place over. But that's how you calculate the dividend yield, and you also can factor in the annual dividend. So this is expected based upon the fact that they raise, if you notice the consistency with these dividends, 0.44 cents, 0.46 cents, what's the most likely anticipated dividend for the next 2 quarters? 0.485, right? So I hope that makes sense. This is on the individual company level. And just remember, when you're investing in these individual stocks, you are becoming a part owner, just as you would a rental property. I think that's the best analogy to understand. If you buy a rental property, even these days they have the partial ownership agreements. And I'll get into that as well. I'll talk about a stock that is known by the name of Realty Income, or O. And that's another company that has been raising their dividends for quite some time. So this is an example of what's called a real estate investment trust, where you can actually buy partial ownership in a real estate enterprise. And so it's a great way to get invested into real estate. And one interesting thing about this is that they pay their dividends on a monthly basis, not on a quarterly basis like most companies do. It's still a company, but there's a different structure set up with real estate investment trust. And so this is just another example. These are not recommendations. We are using these as hypotheticals throughout this. But this company as well has raised their dividends every single year for several years. And so I think it's a good example of the type of companies one should be seeking if they're just getting started and they want to invest in individual dividend stocks. Because like I said, you want to invest in companies that have a history of raising dividends over time so that they keep up with inflation. And also you want to try to invest in companies that maybe their yield is not the highest, but they don't have any dividend cuts, right? They're not cutting their dividends. And there's some exceptions to this rule. I mean, if you really believe that the company will make a comeback, and also it could be a very volatile industry, like commodities, for example. So there's a lot of considerations, but in general, you want to avoid just focusing on the dividend yield and instead focus on the quality of the business and how much they can sustain those dividends, how profitable is the company. So once again, this is another example, Realty Income. I don't want to get into that one just yet. We'll come back to that one, because I was discussing also the ETF market. And so exchange traded funds, like I said, a collection of companies. And we had the Vanguard, if I can find it, I'll just pull it back up here, Vanguard Dividend Appreciation ETF. And so obviously building a portfolio of individual dividend stocks can be challenging, because you have to not only do research on them and figure out which ones are the best to own, but you have to look at all the factors. Just everything involved can be kind of overwhelming, especially as a beginner. So one solution to this, as we mentioned briefly, is talking about the Vanguard Dividend Appreciation Index Fund. And what we have here is, you'll see that it's up 59% in the last 5 years. Now, once again, we have the potential for capital appreciation, and we also have the potential for those dividends, right? So that's the beauty of it. You get the best of both worlds with dividend investing a lot of times if you're choosing those investments that have that upside potential, because not all of them do. But this one in particular does have that upside potential. And we can look at the sheet here for Vanguard. One thing I like about Vanguard ETFs is that, especially if you're a beginner, you don't have to worry about any kind of high fees. So each ETF will have its own expense ratio, which is basically the annual fee that you get charged for owning the fund. And in the case of the Vanguard Dividend Appreciation ETF, that expense ratio is only 0.06%. To put that into perspective, that's actually less than 0.1%. And this fee is also simply deducted from the annual return of the fund. So whatever this ETF will earn in terms of the total dividend payouts, and also in terms of that capital growth of the share price, it'll simply deduct that from the total return at 0.06%. With that being said, you'll see the current market price is $183. And with ETFs, you can buy these on the market. So you're basically buying a diversified portfolio of these companies for a low fee, low annual fee, and you're also being able to do so just like you would in a stock. So that's the beauty of it. And you'll see here that they have the year-to-date returns and all of that kind of stuff. And it also has the product summary. So this seeks to track the performance of the S&P 500 U.S. Dividend Growers Index, and it's passively managed through a full replication approach. So what that means is passively managed. There's not a lot of active management going on, and essentially they're just letting this thing ride out based upon the index. Now, the fund will remain fully invested, and it'll remain invested in large cap equity stocks. So an example of that would be like a Coke, right? A large cap company that emphasizes stocks with a record of growing their dividends every single year. So as we were just talking about What are those companies? Well, we're going to find out if Coke is actually in this portfolio, because it very well could be. And so the idea is we want to increase those dividends over time, and we also want to get some good share price growth in the individual companies we're investing in. So you'll see the performance and the fees and all that. Now, one thing I want to look at, though, is the actual portfolio composition. So that should be on the page here. So we have portfolio composition. There it is. And if we actually look at this, we can see that this is currently invested in 339 stocks. Now, I actually want to try to find those companies and maybe download there should be something to where I can download. Here it is. So this shows you the top 10 holdings. Now, Coke is not in the top 10 holdings, but all these companies you'll see have a history, essentially, of increasing those dividends. Just like we were talking about, we have Apple, Microsoft, JP Morgan, Broadcom, ExxonMobil, United Health Group, Visa, Procter & Gamble, MasterCard, and Costco. So these are some big powerhouses, large corporations that you're taking partial ownership in, and then you're receiving those dividends through this ETF. So I know it can get a little bit tricky with the mechanics, but just remember, ETFs always trade on a stock exchange, and they can be traded during normal business hours, and you can also invest in a collection of dividend-paying companies like these. And so this is the top 10. There should be a way to download all of these, I believe, but nonetheless, you get the idea, and it goes over the distributions. Now, one thing I want to go over next is actually, let's take a look at, I'm going to type this back in on Google, and we'll go back to NASDAQ, so VIG dividend. NASDAQ.com is one of my favorite websites for viewing this information because it's accurate, it's right there in front of you, it's easy to understand. And so what we have here, and this is one thing, we just talked about this, but I want to bring it up again. When you see a dividend yield of 1.67%, it can be discouraging, right? And the reason for that is because when you have a dividend of $1 or 1.67%, and the Fed funds rate is currently 5%, it can feel like you're losing money. But remember, at the bank, you're really not taking ownership of anything. Your money to the bank is a liability, and they want to loan it out, essentially. So they're paying you the difference between whatever they're loaning their money out for, and hopefully the bank doesn't go under and the FDIC doesn't have to come in. Nonetheless, that's a different story. The key with dividends is that you're actually taking partial ownership in these companies, you're owning these businesses, and these businesses can increase their dividend over the long term. And you'll see just that with this ETF as well. So going back over the last 10 years, if we go back to the June 2014 payment, that was about 40 cents per share. So we have a 40-cent dividend, and if we go back to 2024, you'll see that we have a dividend of 90 cents per share. And so that is an over 100% increase, roughly, because you'll see that all these dividends are variable. And that's the key, is because we have a lot of different factors at play here, a lot of different companies that are paying out dividends. And it is possible with a portfolio of over 300 companies that some of those dividends are going to increase, right, quarter to quarter, and some are going to decrease. But the goal is hopefully to get rid of the bad ones and keep the good ones. And even though this dividend yield is low, you've still received over 100% dividend growth basically in the last 10 years. So that's the key, right? If we had a dividend that was going down, on the other hand, the dividend yield might be 10, 15%. But nonetheless, always keep that in mind. And we're also going to get into an ETF here that is another example. Now, I've talked about this one on the channel before. This one is a bit more complicated, and the way this works is not as simple as just investing in a broad collection of dividend-paying stocks that have a history for increasing those dividends. With that being said, we can look at this and kind of think about it from the perspective of what is our long-term goal? What do we want, share price growth, and do we want dividends, or are we just focused on a higher dividend yield initially that gives us the cash flow we need, say, in retirement? So there's different considerations depending on what type of investor you are. Also, we have to think about the tax vehicles we're using, and this comes down to utilizing what's called maybe a Roth IRA. A Roth IRA is my personal favorite. In fact, I'm not associated with Fidelity, but they're the ones that I use. And what I mean by not associated is I'm not sponsored by them. So I'm just using this as an example because I have an account with Fidelity. I have a Roth IRA. And what a Roth IRA allows you to do is when you put the money in there, you contribute that, and let's say you start buying dividend stocks, that money is officially tax-free. If you keep that in there until retirement, you can compound your wealth over, let's say, 20 or 30 years. And by the time you get to retirement, hopefully, those dividends are going to be worth something more than what you put in. And you can start withdrawing everything from the account tax-free. So that's a major consideration, because what I'll see a lot of people do is they'll put money into an individual brokerage account, and then they're owing all the taxes on that income. But if you put this into a Roth IRA, when you get to retirement down the road, then, or, whatever happens, you can take early withdrawals. That's another consideration. But the main consideration with a Roth is that when you start putting money into this, you will basically get those dividends tax-free in retirement, so you won't have to worry about paying any taxes. And I also have education on daily investment advice. Once again, come on over here, check out Roth IRA, and just type that in to the search bar. And basically what you'll see here is that, so I even have a guide on real estate investing within Roth IRAs, which is another topic. Totally, we're talking about dividend stocks and ETFs in this video, getting started with dividend investing. Talk about backdoor Roth IRAs, Roth IRA investing for beginners. So here we go. This would be a good one, and I can leave this link in the description for you guys. With that being said, this is all about managing our cash flow. How do we get to the point where we're, tax efficient, and also we're generating those dividends that over 20 plus years are going to allow us to, retire essentially, and use these dividends for our benefit or our family's benefit, whatever it is. That being said, we can come back to Realty Income. That was another company that I wanted to talk about. Now, as I mentioned, this is very similar to a stock in the sense that you can, just like the ETFs as well and the individual dividend stocks like Coca-Cola, you can buy this company on an exchange, you can open a brokerage account, and you can work with a financial advisor if you feel it's necessary, and you can actually go and buy this company and other real estate investment trusts like this on the open market. Now, the key with real estate investment trust is, here's the basic definition of a REIT, and this comes from Investopedia, great resource as well for learning about investing. But when it comes to real estate investment trust, basically what it is it's a company that owns, operates, or finances income-generating real estate, and it's modeled after mutual funds. REITs pool capital investors who earn dividends from real estate investments. Investors do not individually buy, manage, or finance properties. So what we have here is, it gives you the key takeaways. So it generates a steady income stream for investors, but offers little capital appreciation. It says most REITs are publicly traded like stocks, which makes them highly liquid, unlike real estate investments. So as we were just mentioning about the stocks, trading on the open market, just like that, real estate investment trusts are the same way. And then they can invest in basically anything. They can invest in apartment buildings, cell towers, data centers, hotels, medical facilities, offices, retail centers, warehouses, etc. So let's take a closer look then at Realty Income, and I'll give you my thoughts on this company. Now, as I mentioned, this is one of the premier REITs out there that has been paying dividends for several decades, increasing those dividends as well every single year, just like we talked about with Coca-Cola, and also like we talked about with this Vanguard dividend appreciation ETF. So another example of a company that's been increasing their dividends every single year, and we can look at that dividend history. You'll also notice that the company's down over 22% in the last 5 years. So if you think about, and I'll use this analogy as well, think about a real estate market where it's down, right? You think about a real estate market where you buy a single family home and the home value goes down. What happens is you're losing money on your principal on paper, right? But you still own the property. So you still own the company in this case, and the company's still paying out cash flow. They're still paying out dividends, or the real estate single family home is still paying out dividends or cash flow, monthly rent. So in this case, that's the main benefit as well with investing in a company like Realty Income, is that even though the share price is down, you're still receiving that monthly cash flow from the company, and that's the goal. And even if you look back at all time. Yeah, we've had a retracement since 2020. It's been very tough for a lot of REITs, but nonetheless, we're still hanging in there. Let's just say that, right? And let's take a look now at their total dividends. You'll see that the dividend yield itself in this case is 5.98%. That's a sum of all those dividends, in this case monthly dividends that Realty Income pays. And with that being said, you have 25-cent dividends, 26-cent dividends. This is paid every single month, as you can see, and they're still increasing every year. So going back to 2014, you will see that since June of 2014, which is the month we're in now, almost July, they're paying over 18 cents. And as I mentioned, they can go over several decimal places to, sometimes save on cost and things depending on how much they're paying out in dividends, which in this case, they're paying every single month. So it actually makes sense to go over more decimal places a lot of times. And you'll see that since then, those dividends have just been steadily increasing. So yeah, the share price is down. Maybe this company does run into some trouble. I mean, one thing to consider with all of these companies is that, and I've kind of sound like a broken record when I say this, but past performance is not necessarily indicative of future success, future results. So what we have here is an annual dividend of $3.15. The dividend yield in this case, divided by the current share price of $52.07, is 5.98%. So assuming you invest $10,000 times 0.0598, you get the total answer in terms of how much you would make. In fact, let's go ahead and do that now. And we have $598 in dividends. Now, since they pay that on a monthly basis, if you invest $10,000, you're going to get back roughly $50 per month. Now, you might be looking at that and saying to yourself, man, that's a pretty crappy deal. I'm only getting back $50 a month and I have to invest $10,000. But this is just part of the game, because think about this. Once you get to $100,000 invested into these types of companies, then you're going to start generating over $500 a month. And assuming you're investing in the right companies, then those companies hopefully will keep on increasing those dividends over time. So that $500 you're making on a $100,000 investment is going to be worth a lot more in 10 years, hopefully. You're going to come back and now you're going to be making, just on that initial $500, $750 or maybe even $1,000 a month, right? So that's the entire goal as well. And that's why I tell people, don't just focus on the dividend yield. And this is actually better than, especially this one right here at 1.67. But nonetheless, the dividend yield is kind of a consideration to determine how much you can make it initially with these investments. But it's by far, it's far away from the most important thing, is what I'm trying to say. So in this case, once again, we have an ex-dividend day of 7/1. So you have to buy this stock by 7/1. Today's Thursday, so we basically have until tomorrow, because we have the 28th of June, Friday, and then we have Saturday, Sunday, 29th, 30th. There's not 31 days in June. And then the 1st would be that Monday. So if you buy this by Friday, you'll still get the dividend that's going to be paid out on 7/15. And once they've announced this dividend, it's being paid out no matter what. That's another consideration when it comes to dividend investing. So we have a dividend at 7/1/24, and that is the ex-dividend day. So that means you have to own this stock by Friday market close. And I think you can actually do it in extended hours too, if I'm not mistaken. It doesn't matter what time a day it is. But basically what this means is 7/1/24, payment day is 7/15/24. That's when you're actually getting paid this dividend. But you have to own this real estate investment trust or Realty Income by Friday to receive that next one. So that's an example of how this works. Because if you buy it Monday on the ex-dividend day, which is at 7/1, it's too late in that case. So with that being said, I hope this kind of gives you a high-level overview of dividend investing for beginners. I wanted to go over, I think, one more ETF, and this is where it gets a little bit more complicated because when I worked at Charles Schwab, I actually talked on the phone with a guy. I forget his name. Really nice guy, but he invested in this ETF, and he invested in another one as well by the name of JEPI. So there's JEPI and JEPQ, and once again, we're just using these as an example. But you can see here that this pays nearly 10%. So you can see also how this might be attractive for somebody who is looking at retirement and looking at getting those dividends. And the key here, I think, and I don't know why it's not loading for me, but let me try to close some tabs here. Maybe that'll help out. Let's let this load real quick. So we have, okay, so 10% dividend yield, annual dividend of $5.39. We're taking that by the current share price of $55. So basically almost a 10% dividend yield you're getting. And you can see these monthly, once again, a monthly paying dividend ETF. What you'll see with a lot of these ETFs, not all of them, but some of them, depending on the strategy they're utilizing. And this one, like I said, it's much more complicated in terms of the strategy, especially if you're new to dividend investing, because yes, they're paying dividends on a monthly basis, and yes, the yield is over 10%. But what are you actually sacrificing in return? And in this case, this ETF, I would say, and I've talked about this one on the channel before, has done a pretty good job overall, right? So if we look back at the history for this ETF, you can see that, and once again, it's an ETF, so it trades on the exchanges. Just a reminder, I like to try to reinforce these core concepts. So you can buy this one just like any of the other ones we talked about in this video. If you go on a stock brokerage account and you actually buy this ETF, you can do so. And you'll see that it was trading at $40 per share in 2022. Now it's trading at $55. So we have had some share price appreciation. In addition, this thing pays nearly a 10% dividend yield. So if you take the math on this, a $10,000 investment times, we'll take the actual dividend yield of 0.0972. Currently, if you were to buy this right now, you could divide it on a monthly basis since it pays on a monthly basis. And essentially, you're looking at roughly $80 per month per $10,000 investment. So if you have an ETF that is paying 7%, you just do the same thing, take 0.07 and then divide it by 12 or divide it by 4, depending on how they're paying out those dividends. A lot of them will pay quarterly, like the Vanguard ETF we were talking about, that pays every 3 months. And in this case, $80 per month essentially is what you're looking at. And if we look back at the history since this ETF came out in 2022, it's still fairly new, but you'll see they're paying in the 30 cents per share. They had one dividend that was 54 cents per share. But basically what you have to keep in mind with some of these ETFs is that since this one kind of does a more complicated strategy than your typical, basket of companies, as we were talking about with that Vanguard ETF, yeah, you have a higher dividend yield, and yeah, the share price actually has held up decent, right? I mean, sometimes what you'll see with these very high yield ETFs is that the share price simply does not keep up. And in this case, it's not performing as well as the market by any stretch of the imagination. If you look at the actual S&P 500, it's still up 16%. So maybe I'm wrong. I haven't looked at the S&P 500 total return. In fact, let me go ahead and do that. But in this case, I think you're underperforming the market, right? So even though it's up 16%, the S&P 500 is up 25% in the last year. So you're underperforming on the share price, but you're still getting that very nice dividend yield. And so in this case, this is kind of an exception to the rule. You have a high dividend yield, but the share price is not going down, and the dividends themselves are fairly consistent. I mean, a 39-cent dividend, 34, but anywhere basically in the 30s to 50s, you can kind of estimate is what you're going to be receiving. So if you can kind of anticipate that, and let's say you're a retiree looking at cash flow solutions, this is why these ETFs are so popular. And this one in particular is known as like a covered call options type ETF, and these have become a lot more popular. But you can type in on Google, for example, a covered call ETF or an options-based ETF where they utilize option strategies, and that's why this is a bit more complicated for your typical beginner dividend investor. But I did want to bring this up because there are funds like this out there that pay on a monthly basis, and when they're paying out these dividends, they're also maybe growing the share price. So you're getting some share price appreciation in this case, up 12% since inception, basically since 2022 when it came out, and in the last year you're still up over 16%, and you're getting that on a regular basis. So with that being said, I hope you guys enjoyed this tutorial. My goal was to kind of keep this under 45 minutes, and I think we're approaching that now. So if you have any questions or comments, please leave them in the comments down below. I will do my best to respond to everybody and to really try to answer any kind of guidance you guys might need on this, because especially being a new dividend investor, you want to get started, you want to take control of your financial future, but there's a lot to learn, right? So keeping that in mind, you can always come over to Daily Investment Advice. We have free education, free resources. We have a lot of stuff, especially on retirement, and you come over to cash flow and dividends. You can learn about retirement accounts. I talked about the Roth IRA. I talked about that. But basically, come on over to the website, learn, educate yourself, sign up for the newsletter so you can, I'll send out emails periodically just reminding you of some of our latest content. And you can learn about exchange traded funds, as we were just talking about. You can learn about some specific ETFs, like the one, I think, JEPQ, the one we were just talking about. Here it is. So this actually is a guide on how to make over $1,000 every month with the JEPQ ETF. I made a video on this as well, but you can check that out. That was the most recent one, once again, we were just talking about. So lots of different strategies, lots of different ways to do this. But the key first, I think, also, instead of just jumping right in, is to educate yourself on, how do we get a plan of action going to where we're going to do this on a consistent basis? How do we get to the point where we can have a monthly amount that we're putting into this? And then how do we take that monthly amount and use dividends and these specific investments, perhaps some of these? One I forgot to mention is Rio Tinto. This is a mining commodities company, for example, pays a 7.72% dividend. Another example, you'll see the annual dividend, and you can take that by the current price to get the current dividend yield of 7.72%. This one in particular pays on a quarterly, or this one is more infrequent, so this is another consideration. I don't want to dive down that rabbit hole in this video, but I've talked about this company as well. And so really what it comes down to, guys, is just choosing a strategy that you feel comfortable with, based upon your risk tolerance, investing goals. Consider consulting with a financial advisor if you feel it's necessary. I know there's a lot to learn, and especially if you're brand new to this. One other consideration is that I do offer consulting on this, and so you can check out that link in the description if you're interested in signing up for a one-on-one session where I can just talk to you individually about some of these things, and I'll leave that link down below. So be sure to check that out, guys. With that being said, I hope you enjoyed this video, and I hope you learned something. I hope this gives you some solid education for how you can go about dividend investing. And as a beginner, like I said, there's a lot to learn, but hang in there. Go to my website, go to Investopedia, other websites, educate yourself, learn about the markets. And once you've done that, you're going to be put in a position that's much better than a lot of people, because the traditional school system, unfortunately, does not teach this stuff. And so it's very unfortunate. That's one of the reasons I'm so passionate about this type of content, is because, unfortunately, kids are not learning this stuff in school. And so they're coming out and they don't know what they're doing. But hopefully this helped you today. If so, give me a thumbs up, hit that subscribe button, and we will see you guys in the next video. Take care.